Why 2025 could be a crucial year for your retirement savings. What if the next market crash wiped out a huge chunk of your retirement savings? It's a scary thought, but one that many retirees face when markets take a dive. You've spent years building up your nest egg, but how do you keep it safe when the market gets unpredictable? In this video, we'll dive into practical steps you can take to protect your retirement savings from market crashes in 2025. We'll talk about how to assess your risk tolerance, build a portfolio that can withstand volatility, and why holding more cash might be a smart move. Plus, we'll explore alternative assets like bonds and real estate that can help add stability to your retirement plan. If you're worried about what a market downturn could do to your financial future, stick around. You'll get actionable advice that can help you feel more secure no matter what the market throws your way. Understanding market volatility in retirement. Market volatility refers to the frequent and often unpredictable price changes in financial markets. For retirees, this can be especially concerning because their investment portfolios are typically more sensitive to sudden drops in value. Unlike younger investors who have more time to recover from market dips, retirees often rely on their savings to cover daily expenses, leaving less room for recovery after a crash. One major challenge for retirees during a market crash is the reliance on fixed income. Whether through pensions or withdrawals from retirement accounts, retirees often need a steady stream of money to maintain their standard of living. If a significant portion of their portfolio is invested in stocks, a sharp market downturn can result in immediate losses, forcing them to withdraw more than planned just to cover basic costs. This, in turn, depletes their savings faster, making it difficult to regain lost value. A clear example of this is the 2008 financial crisis. Many retirees saw the value of their investments drop by nearly 50%, with some being forced to sell off assets at a loss just to meet their living expenses. For those already in retirement, the road to financial recovery was slow and often painful. Now, let's look at how assessing your risk tolerance can help you protect your retirement savings from future market downturns. Assessing your risk tolerance as a retiree. As you get older, understanding your risk tolerance becomes more important. Risk tolerance is simply how comfortable you are with the possibility of losing money in your investments. Some people are okay with taking big risks for potentially higher returns, while others would rather play it safe, especially when retirement is on the horizon. Knowing how much risk you can handle is key to protecting your savings. Start by thinking about your overall financial stability. If you have a steady pension or a good amount of savings outside your investments, you might be able to take on a bit more risk. On the other hand, if your income is tight or you're relying heavily on your retirement accounts, you'll likely want to limit exposure to risky investments. Health is another factor to consider. If you're facing potential medical expenses or other unexpected costs, having a safer portfolio can provide peace of mind. It's important to think about your future needs too. How long do you expect your savings to last? Will you need extra funds down the road? These questions can help you gauge how much risk makes sense for your situation. One simple way to calculate your risk tolerance is by using the Rule of 100. Subtract your age from 100, and that's the percentage of your portfolio that can be in stocks. The rest should be in safer investments, like bonds or cash. So if you're 70, you might want no more than 30% of your portfolio in stocks. Once you have a good idea of your risk tolerance, it's time to think about building a portfolio that can withstand market volatility. Creating a defensive portfolio for 2025. A defensive portfolio is designed to protect your retirement savings from major losses during market downturns. It focuses on minimizing risk and ensuring steady returns. which is especially important for retirees who can't afford large hits to their savings. The goal is to balance lower-risk assets that hold up better during volatile times, providing a sense of stability and security. For retirees, having a defensive portfolio is critical because they rely on their savings for daily expenses. A sudden market crash can wipe out a significant portion of those savings, making it harder to recover. By shifting to safer investments, you reduce the chances of experiencing large losses when the market takes a dip. So, how do you create a defensive portfolio? Start by focusing on a mix of lower-risk assets like bonds, dividend-paying stocks, and cash equivalents. Bonds tend to be less volatile than stocks, making them a reliable option for protecting your capital while still generating some income. Dividend-paying stocks can provide a steady income stream, but stick to well-established companies that have a history of weathering market downturns. Another tip is to avoid putting all your money into one type of investment. Diversification is key to spreading risk across different asset classes. This way, if one area takes a hit, others can help balance out your portfolio. It's also important to think about preserving your capital while generating enough income to cover your retirement needs. By finding the right mix of income-generating assets and safer, capital-preserving investments, you can create a portfolio that protects your savings without sacrificing too much growth potential. Now, let's take a closer look at how bonds can play a central role in this kind of strategy. The role of bonds in safeguarding your retirement savings. Bonds are a popular choice for retirees because they offer stability and predictable income. When you buy a bond, you're essentially lending money to a government or company in exchange for regular interest payments and the return of your money when the bond matures. This makes bonds a safer option compared to stocks, which can be more volatile. Government bonds, like U.S. Treasury bonds, are considered one of the safest investments because they are backed by the government. These bonds provide steady interest payments and are less likely to be affected by market ups and downs. Corporate bonds, issued by companies, tend to offer higher interest rates than government bonds, but carry a bit more risk depending on the company's financial health. Still, for retirees, bonds are a way to balance income generation with protection against market volatility. One thing to watch out for with bonds is inflation. Over time, rising prices can reduce the purchasing power of the interest you earn, meaning your money might not go as far in the future. But despite this, bonds remain a key part of a defensive portfolio, offering stability in uncertain times. Next, let's explore how increasing your cash holdings can provide additional security during market downturns and help you cover short-term expenses without needing to sell off investments. Increasing cash holdings for flexibility. Holding more cash during uncertain times can act as a financial buffer, helping you avoid selling investments when the market is down. Cash is a liquid asset, meaning it's easy to access and use for short-term expenses without worrying about market fluctuations. When markets dip, having enough cash on hand can give you the peace of mind to ride out the storm rather than being forced to sell investments at a loss. One key benefit of holding more cash is flexibility. If the market takes a turn for the worse, you can rely on your cash reserves to cover living expenses, allowing your investments to recover over time. It also gives you the opportunity to buy into the market when prices are low if that aligns with your strategy. So how much cash should you hold? A good rule of thumb is to keep at least 6 months to a year's worth of living expenses in cash. This ensures you have enough to cover your needs without dipping into your investments. Just be mindful of inflation, as too much cash can lose value over time if prices rise faster than your money grows. With a solid cash reserve in place, you're better positioned to handle market volatility. Now, let's look at how diversifying your investments across different asset classes can further protect your portfolio and reduce risk. Diversifying beyond traditional assets. Diversifying your retirement portfolio means spreading your investments across different types of assets to reduce risk. In uncertain markets, this strategy is especially important because it helps cushion the impact of a downturn in any one area. Instead of relying solely on stocks or bonds, you can include a variety of assets that perform differently under changing market conditions. Alternative assets like real estate, commodities, and Treasury inflation-protected securities, TIPS, can play a valuable role in this mix. Real estate investments, whether through direct property ownership or real estate investment trusts, REITs, often offer steady income and tend to hold their value during times of inflation. Commodities, such as gold or oil, can also provide protection since their prices often rise when inflation increases or when the market becomes volatile. TIPS are another useful addition to a diversified portfolio. These are government bonds designed to protect against inflation. Unlike regular bonds, the principal value of TIPS increases with inflation, ensuring that your purchasing power remains intact, which can be critical when prices rise. By including these alternative assets, you're not putting all your eggs in one basket. If one part of the market struggles, these other assets might perform better, helping to balance out your portfolio. This reduces the risk of significant losses and provides more stability for your retirement savings. Now that we've covered diversification, it's important to talk about rebalancing your portfolio regularly to maintain the right mix of assets and ensure your investment strategy stays aligned with your goals. Rebalancing your portfolio to match market conditions. Portfolio rebalancing is the process of adjusting your investments to maintain your desired mix of assets. Over time, market fluctuations can cause certain investments to grow or shrink in value, throwing off the balance you originally set. For retirees, this can be risky because an unbalanced portfolio might expose you to more risk than you're comfortable with, especially during volatile markets. For example, if stocks in your portfolio perform well, they might end up making up a larger percentage of your investments than you intended. This could leave you more vulnerable to a market downturn. Rebalancing helps you bring things back in line, ensuring you're not taking on more risk than planned. The process of rebalancing is straightforward. First, assess your current asset allocation. Compare it to the original percentages you set for stocks, bonds, and other assets. If the mix has shifted too much, it's time to rebalance. To do this, you can sell a portion of the assets that have grown larger than your target and reinvest in those that have fallen below their target percentage. Many financial platforms also offer automatic rebalancing features that can do this for you on a regular basis. Rebalancing is particularly important in retirement because you're less able to recover from large losses. By keeping your portfolio in check, you maintain the right balance of growth and safety. Next, let's explore how you can protect your income streams during market downturns, ensuring that your cash flow remains steady even when the market is uncertain. Protecting income streams in a down market. Retirees can maintain steady income during a market downturn by diversifying their sources of cash flow. One common strategy is to invest in dividend-paying stocks from well-established companies. These stocks provide regular payments, regardless of the stock price, which can help cover expenses without needing to sell investments during a downturn. Another option is annuities, which are contracts with insurance companies that guarantee a fixed income for a set period or even for life. Annuities can provide a reliable source of income that isn't affected by market swings, offering retirees peace of mind. Rental properties are also a potential income stream. If you own real estate, renting out property can generate monthly income. which can be particularly helpful when other investments are underperforming. By combining these strategies, retirees can create a steady income stream to weather market fluctuations. Now that we've covered ways to protect your income, it's a good idea to think about working with a financial professional. They can help you make smart decisions, adjust your strategy, and ensure your retirement plan is on track, even in uncertain times. Working with a financial professional to stay on track. Working with a financial advisor can make a big difference when navigating market volatility. Advisors can offer personalized advice tailored to your retirement goals, helping you adjust your portfolio and protect your savings during uncertain times. They can also help you stay on track with your investment strategy, even when the market feels unpredictable. When looking for the right advisor, start by checking their credentials and experience. Make sure they have a background in retirement planning and understand the unique challenges retirees face. Ask for references or reviews from other clients to get a sense of how they've helped people in similar situations. Some key questions to ask include: how will you help me adjust my portfolio for market downturns? What strategies do you recommend for generating steady income in retirement? And how do you charge for your services? It's important to find an advisor who listens to your concerns and provides clear, actionable advice. With a trusted advisor guiding you, you'll feel more confident in your financial decisions. Now that we've covered the key strategies for protecting your retirement savings, it's time to bring everything together in the final conclusion. Staying proactive and preparing for the future. To protect your retirement savings from market crashes in 2025, taking a few key steps can make all the difference. Start by understanding your risk tolerance and adjusting your portfolio to match it, ensuring you're not exposed to more risk than you can handle. A defensive portfolio, with a mix of bonds, dividend-paying stocks, and cash, can help create stability when markets get shaky. Diversification is crucial. By spreading your investments across different assets like real estate, commodities, and Treasury inflation-protected securities, you reduce the chances of one market dip derailing your entire plan. Regularly rebalancing your portfolio ensures that you're always aligned with your goals, keeping your investments in check as market conditions change. Don't forget to maintain steady income sources through strategies like annuities or rental properties, so you're not forced to sell investments during downturns. And if you're unsure about making these adjustments on your own, working with a financial advisor can provide valuable guidance tailored to your unique situation. Staying proactive and making informed decisions will help you weather any storm. By taking control of your retirement strategy now, you're setting yourself up for long-term financial security. So take charge, be confident, and protect the future you've worked so hard to build.